This morning, a projection landed on my desk, finalized by Deloitte Canada and FIFA's own economists, that demands immediate attention. It confirms that the 2026 FIFA World Cup, set for a limited run of just 13 matches on Canadian soil, is unlocking a $3.8 billion economic activation. This is not a projected high watermark. It is the calculated, confirmed positive economic output that Canada has been engineering with quiet precision for years. The timeline leading to this specific output figure did not happen by accident. It began with a calculated bid, years of specific lobbying, and millions in upfront preparation costs, long before the host cities of Toronto and Vancouver were even confirmed. The $3.8 billion number doesn't just represent match day. It covers the entire preparation and hosting period, defined as June 2023 onward, revealing a strategic multi-year economic playbook. Here's what that detail tells you. Deloitte's independent analysis broke that $3.8 billion figure into three highly functional, transparent buckets that move far beyond simple revenue generation. They confirmed that $2 billion is flowing directly into Canada's gross domestic product as actual income. Another $1.3 billion is designated as labor income, going directly to Canadian workers, not multinational corporations. And perhaps most critically for fiscal planning, $700 million is landing as government revenue from tax and related economic activity, providing a direct return on public investment. This methodology is not a simple post-event guess. This is FIFA's first ever formal pre-tournament economic impact assessment ever conducted globally. Deloitte's sport business advisory practice ran every single specific number independently and carefully, ensuring that the methodology fully covered capital expenditure, operational spending, and full, verified visitor expenditure projections before a single fan arrives. That detail tells you the level of scrutiny being applied. And it's why the efficiency metric is genuinely impossible for any other host nation to ignore. Canada is only hosting 13 total matches, yet that ratio of events to output is unprecedented. Every single match Canada hosts, across both Toronto and Vancouver, generates an average of 155 million GDP. Not output, not indirect multiplication, a 155 million in direct contribution to gross domestic product per match every single game. When you juxtapose that with the United States hosting 60 matches, or Mexico hosting in 3 of its major economic hubs, the standard efficiency model is completely rewritten. While other hosts will achieve higher total numbers due to scale, Deloitte has confirmed that Canada's structure is projected to create and sustain the most jobs per individual match of any host nation globally. Canada is on track to generate or sustain 1,850 jobs nationally per single match. To understand how that surgical efficiency is being achieved, you must study the internal allocation of the events. British Columbia is hosting 7 of those matches at Vancouver's BC Place, and that single province activation is generating $1.7 billion in total economic output, with $980 million hitting BC's GDP directly. That includes $610 million in provincial labor income and creates or preserves over 13,700 jobs within the province. What this structure reveals is that the required $180 million renovation of BC Place, including a new natural grass pitch, widened field, and upgraded broadcasting suites, was not a cost, but a trigger. This stadium will now serve Vancouver's economy for the next 2 decades, using the World Cup as a funded mechanism for permanent infrastructure that the city could not have otherwise afforded. Ontario's parallel strategy reveals a duplicate structure, where 6 matches in Toronto are projected to generate $1.3 billion in total output and $700 million directly into the provincial GDP. With $460 million in labor income, the operation is creating or preserving over 8,700 jobs in Ontario alone. The BMO field site itself received a $157.9 million complete renovation, including expanding capacity to 45,736 and overhauling broadcasting infrastructure. But here is where the critics, who initially saw the city budget for hosting balloon from an initial $30 to $45 million up to $380 million, missed the true scale. Toronto's economic assessment is now projecting $940 million in economic output for the Greater Toronto Area alone. That is a 2.4 times return on the $380 million spend. inside a single metropolitan economic zone, answering the return on investment question clearly. But the most consequential number, the one indicating a much deeper strategic activation beyond the stadium footprint, was revealed yesterday. While the expansion of the metropolitan hosting budget's initial critics into a 2.4 times local return clarified the concrete baseline of the tournament, the true strategic activation of this multi-billion-dollar operation extends far beyond local borders. The immediate economic impact, derived from stadium renovations and ticket sales, establishes the foundation. But the true geopolitical layout hinges on an entirely different mechanism. It is a long-range blueprint targeting structural economic leverage and trade positioning that is beginning to unfold. Yesterday, a disclosure from Corporate Travel Metrics confirmed a broader corporate pattern that aligns directly with this calculation. Toronto saw combined hotel and flight booking spend jump 486% year-over-year, alongside a 300% surge in overall World Cup booking demand across Vancouver. That baseline indicates that the initial hosting cost is functioning as a structural anchor for real-time executive capital distribution. Corporate entities are booking flights an average of 119 days in advance, a metric that reflects intense forward planning rather than casual consumer demand. This scale of corporate deployment systematically converts sports infrastructure into a highly targeted networking platform for multinational trade interests. That data is backed by long-range regional planning that maps out the trajectory of the tourism sector for the next half-decade. Destination Vancouver, which operates within a $9.6 billion domestic visitor economy, has finalized long-term projections banking on over 1 million out-of-province visitors between 2026 and 2031. That specific timeline shifts the evaluation of the event from a single-month footprint to a sustained 5-year capital infusion. These individuals are projected to spend an estimated $1.05 billion during that secondary window, permanently altering the recovery timeline for local infrastructure, hospitality, and retail sectors. What this structural timeline demonstrates is that Canada is intentionally using a brief sporting window to reset its long-term brand equity on the global stage. CBC, Show 1. The justification for this multi-year approach is highlighted by official statements from provincial leadership, who are framing the spending through the strict lens of investment returns rather than public deficits. British Columbia's calculations forecast total revenues between $448 million and $178 million, leaving a net core hosting cost of between $85 million and $145 million. Minister of Tourism, Arts, Culture and Sport Spencer Chandra Herbert clarified this balancing act by stating, "If you're spending between $85 million and $145 million in net core cost to host World Cup, and then that leads to $1 billion in investment in the province through increased tourism, that obviously makes sense." What that response reveals is a deliberate choice to absorb short-term fiscal outlays to anchor a massive regional tourism multiplier. This dynamic directly shifts the gravity of the tournament away from transitory entertainment and toward calculated provincial asset building. Yahoo! Finance Canada that regional asset building is now intersecting directly with a highly volatile international trade environment, where macroeconomic pressure is testing Canada's structural resilience. Deloitte's broader quarterly economic outlook for 2026 notes that Canada's overall economic growth is projected to slow to 1.5% this year, as trade uncertainty and United States tariff exposure continue to strain domestic production. This specific deceleration means the high-efficiency GDP return of $155 million per World Cup match is landing precisely when the broader economy requires immediate non-export stimulus. The targeted job creation of 1,850 sustained positions per match provides a calculated buffer for the domestic labor market during a period of reduced corporate hiring nationwide. Global News is Show 1. The collision of this high-efficiency sports stimulus with broader trade vulnerabilities is forcing Canadian policymakers to run a dual-track strategy. On one side, the nation is deploying billions to insulate sectors impacted by manufacturing and resource tariffs, while simultaneously using global events to build alternative economic corridors. Every international delegation and corporate partnership secured during these matches reduces long-term structural dependence on single-market trade relationships. This integration of sports diplomacy and fiscal insulation represents a highly synchronized effort across federal and provincial levels to protect domestic GDP. But the final realization of this dual-track strategy, the exact pivot point that international trade lawyers and corporate investors are watching with intense strategic scrutiny, remains tethered to a rigid diplomatic timeline. The formal multilateral review of the Canada-United States-Mexico Agreement, scheduled to open formally on July 1, 2026, will ultimately dictate whether these domestic asset upgrades can fully bypass the friction of a continental trade war. Navigating the structural interplay between short-term domestic stimulus and the long-range realities of trade law requires looking directly at the underlying pattern rather than the daily headlines. While the technical framework of the upcoming trade negotiations introduces explicit variables across multiple supply chains, the broader trajectory of Canada's economic deployment remains remarkably consistent. The core operation is not about navigating a single summer of sports or a single month of diplomatic talks. It is a coordinated, deliberate shift designed to construct permanent, insulated economic corridors for the principal global actors. This strategic transition fundamentally alters the operational calculus. For Canada, the realization of this architectural blueprint translates to a permanent upgrade of its metropolitan assets and a multi-year injection of direct, non-GDP, serving as a vital macroeconomic buffer against slowing industrial sectors. For the United States, the high efficiency of the Canadian hosting model demonstrates that localized supply chain integration can yield extraordinary financial returns without sacrificing employment metrics. A realization that domestic manufacturing giants are already weaponizing in their own lobbying efforts. Meanwhile, for emerging investment corridors in Europe and across the Indo-Pacific, the deliberate conversion of a brief sporting window into a long-range corporate activation establishes Canada as a highly sophisticated, predictable target for long-term capital allocation that can bypass continental trade friction. The next tactical maneuvers will naturally reflect this calculated redistribution of economic weight. Rather than succumbing to the immediate pressures of industrial tariff deadlines, Ottawa is on track to continue using its robust, multi-billion-dollar domestic insulation framework to preserve manufacturing employment, while simultaneously expanding alternative consumer and tourism corridors. Concurrently, the major automotive and hospitality syndicates will inevitably leverage these confirmed corporate spending surges to demand greater structural predictability from regulatory bodies, forcing a pivot from political rhetoric to technical compromise. What this systematic alignment reveals is that the old paradigm of treating major global events as isolated, debt-fueled expenditures has been permanently replaced by a model that prioritizes surgical capital return and targeted trade positioning. Ultimately, the singular, most critical takeaway from this entire deployment is that economic leverage is no longer defined solely by traditional manufacturing dominance or raw export volume. By engineering a high-efficiency hosting framework that extracts $155 million in direct GDP contribution from every single match, Canada has successfully demonstrated how a mid-sized economy can transform transient global visibility into a permanent, insulated foundation for long-range growth. This is the quiet, mathematical transformation that outlives the shifting headlines of trade disputes and short-term political cycles, proving that strategic foresight remains the ultimate arbiter of sovereign wealth. The board has been permanently reconfigured, and the real dividends of this multi-year calculation are only beginning to accumulate.